Hello everyone, welcome back. So this is the second segment of private investments and structures. This is going to be a bit of a longer session, so please bear with me. We are going to look at public versus private market performance, and after which we are going to look at private investment matrices. Right, so let's get right into it. The difference in market performance for public and private markets is such that, remember, public markets, these are investments that are listed on a stock exchange. It could be in exchange traded or over the counter. And in private markets, these official markets do not exist. So this could be private equity, private debt, private real estate, private infrastructure, or private special situations, which we are going to discuss each one of these in turn and throughout this entire series on private markets. Right. The performance measures for public markets are based on periodic income, things like dividends for equity, coupons for fixed income, and maybe basically an appreciation of an asset value over time, the price of an asset. These things are traded continuously on the market. And private market investments are evaluated over a long time period, and hence the returns are evaluated over multiple year period or your multi-year period. And we are going to use internal rate of return and the return on investment. We are going to talk about these two just now. Public markets are highly liquid and there is price transparency. Because of high liquidity and price transparency, they are chances of arbitrage opportunities. So because of high transparency and high liquidity, the chance of arbitrage opportunity, and this is not the case in private markets. Private markets, remember, we said these are highly illiquid and there's a lack of transparency. Therefore, it's going to be very difficult to compare them to evaluations in public markets. The valuation approaches for private markets, these are going to be complex because some assets can be unique, the cash flows are irregular, and the time horizons are longer. And on the contrary, public markets, the valuation is easier because the prices are observed regularly based on trading data on the stock exchange or on the market. Return measurements for public markets are consistent, they are predictable, they are periodic, for instance, annually, semi-annually. And for private markets, the return measurements are going to be over extended periods of time. It could be 5 years, it could be 10 years. And the cash flows, they consider the timing of the cash flows, which are usually irregular, right? They are not irregular cash flows, unlike in public markets. So there are some investment challenges in private markets because they require a unique understanding of the market scenario. You have to understand long-term capital commitments, the irregular returns, and the economic environment. In public markets, in some instances, you might have limited transparency on the market and a relatively stable returns. So these are some of the investment challenges in public markets and private markets. Now, I mentioned to evaluate private investments, we are going to consider internal rate of returns and the return on investment. Your internal rate of return is the rate of return for which the net present value is equal to 0. And you could actually calculate it if you manage to get the return on investment. You can calculate the internal rate of return using the return on investment using this formula, where you take the return on investment and you equal to 1 plus the internal rate of return to the power of n, the number of the years in the holding period. Let's look at this example here. This example, you have it's a very simple application of this formula, so you could give it a try by pausing and then coming back, and you see it's very, very straightforward. Okay, let's quickly do it together. After a 5-year restructuring period, so you have a period here of 5 years, and after a 5-year restructuring period, assume Gladstone Partners can sell its initial 375 million Canadian dollars, equal to 30% of the original 1.25 billion purchase price, equity stake into Straplock Industries for 1.45 billion. The first question is, we assume that Gladstone makes a single initial investment and received no dividends. So there are 0 dividends or distributions over the 5-year prior to sale. Calculate the return on investment. Remember, the return on investment based on this formula, it's simply the sum of the cash flows that have been received, and this is divided by the sum of the cash flows invested. Okay. The cash flows that are received in this instance, they are going to sell for 1.45 billion. They're going to sell for 1.45 billion, all right? 1.45 billion, and they can, the initial price was 375. So you divide this by 375. This is the cash that was invested. This is the cash you're going to receive from selling. So the return on this investment is going to be, you just divide these two and you get 3.87 times. That's the return on this investment, right? Very straightforward. It's a simple application of this formula here. So make sure you remember this formula. Gladstone Partners has a target return of 30% over a 5-year holding period on its buyout equity portfolio. Discuss whether the Straplock Tech private transaction meets Gladstone's target and how the investment return would be affected if the investment were realized for the same amount and proceeds distributed earlier. All right. So in this instance now, you want to calculate the internal rate of return, right? Because the target for the return is 30%. That is the targeted return, 30%. So you calculate your internal rate of return and compare it to 30%. Remember, you can simply apply this second formula here, where the return on investment, which is 3.87 times, is equated to 1 plus the internal rate of return. I'll just write it as IRR to the power of n. The number of years is 5, so we raise this to the power of 5. So your internal rate of return would simply be 3.87 to the power of 1 over 5 minus 1, and you get an internal rate of return. If you calculate this, solve it in your calculator, you get 31.06%. And you see that this is greater than their target of 30%. And hence, since it's greater than the target of 30%, an earlier distribution of proceeds is going to benefit Gladstone's returns. So that's the answer for these two, based on simple applications of these formulas. Very straightforward to apply. Okay, let's look at this case study. Let's quickly consider the case study here. You can pause and read through the case study, but what is going to be important here is the fact that the manager expects public and private equity investment values to generate a return on investment of 2 times over a period of 7 years. So you have two things: a period of 7 years and a return on investment of 2 times. The first question wants you to calculate the internal rate of return over the 7-year holding period. And because you are given a return on investment, you can calculate the internal rate of return by saying 1 plus the internal rate of return to the power of n. This is given as 2. This 1 plus IRR is given to the power of n, which is 7. So your internal rate of return is 2 to the power of 7 minus 1. And then you multiply this by 100%. You are going to get 10.41%. So this is how you calculate the internal rate of return for the 7-year holding period. You use the return on investment, which is given to you as 2. This is given. Yeah, all right. So this is straightforward. Let's go to the second one. Assume the private equity fund makes a single capital call in 2 years. So in 2 years, there's a single capital call that is 500,000 US dollars, and this will be deployed in the second year. So the call is made in 2 years, but it's deployed in the second year. It's going to be deployed in the second year. Discuss why an investor cannot simply solve for the expected private investment return using the 5-year time horizon. An initial cash outflow 500,000 and a future inflow of 1 million. All right. So I guess you understand what is going on here. This person is going to assume that they might invest 500,000, and after investing 500,000, they are going to get 1 million from that investment. That investment is going to double. That's what they're going to assume, because remember, the return on the investment is 2 times. So it will go from 500,000 to 1 million in a period of 5 years, right? So to calculate the internal rate of return in this instance, what this person might do would be to take this return on investment and equate it to 1 plus the internal rate of return, and then raise this to 5 years, right? Because it was deployed after 2 years, but it was invested for 5 years for a 5-year horizon, right? So if you solve this here, when you raise it to the power of 5, you're going to have your internal rate of return equal to 2 to the power 1 over 5 minus 1, and then this is going to give you 14.87%. This is quite high. It's higher than the 10.41% that we got initially. But the issue with this is that it ignores the opportunity cost. It ignores opportunity cost. Remember, opportunity cost is the value of the foregone best alternative, right? And this committed capital was not invested in the first 2 years. In the first 2 years, this was not invested. So there's a loss in terms of where this money could have been invested, right? It could have been put into a risk-free interest-bearing account and made some money in those 2 years. It ignores that, and it just takes into account the return over 5 years. But the initial 2 years before it was actually deployed in the second year, there's an opportunity cost there, which is going to be ignored, right? So what you can do is to assume that it generates a return of 10.41, right? So we are going to assume a return of 10.41 and see by how much this money is going to grow over the period of 5 years. You're going to have your 500,000, right? Then we assume this internal rate of return that we calculated initially, which is 1.1041, and this is for a 5-year period. If you solve this, you're going to have over 5 years 820, 374. So this is by how much this investment is going to grow, right? And then to get the return on this investment is the sum of the cash that is going to be the outflow. This is the amount that you're going to sell the investment for, and you divide this by the money that you invested initially, 500,000. If you divide this, you're going to get a return on this investment of 1.64 times. You're going to get 1.64 times, and then you now use this 1.64 times to calculate the internal rate of return. And you remember that the internal rate of return is simply going to be 1.64 times. Then for the period of 7 years now, you take this to the power 1 over 7 minus 1, and then you're going to get 7.33%. So that's how you're going to get this internal rate of return when you take into account the fact that there is an opportunity cost in the first 2 years in which the capital was not deployed. And this is actually lower than what we got initially for the entire 7 years. All right, let's go to the next one, where it says given the uncertainty surrounding the timing and magnitude of the capital calls for the private equity fund, the manager decides to invest committed capital in a liquid short-term fixed income fund and returns 3% per annum. So there's now an investment. So there's some money that is going to come from this investment, right? And this is for 2 years for 3%. So if you take this 500,000 and you invest it for 2 years for 3%, it's going to be 1.03 squared. And you're going to get a total amount of 530,450 Canadian dollars, right? And then to now see how this money grows in the following 5 years with an internal rate of return of 10.41%, you now take the 530. It has made some money from that investment in the 2 years. In the second year, it's then deployed, and then it's deployed with this internal rate of return it's 10%, 10.41%, and this is going to be done for 5 years. If they invest this for 5 years now, it's now total of 7 years. The first initial years where the capital is called, and then the second initial 2 years where the capital is deployed, and then is called and then deployed in the next 5 years, total of 7. The 530 grows by 10.41%, and it's going to give you 870,335, right? And once you get this now, to get the return on this investment, it's the money that you're going to sell your asset for at the end of this life, the cash that you're going to get, the cash inflow over the cash invested. We invested 500,000, that as our initial investment, which was 500,000. If you calculate this, you're going to get 1.741 times is your return on investment. And once you get this return on investment, remember the return on investment can be calculated as 1 plus the internal rate of return to the power of n. And our n is these 2 periods, the capital call and the deployment. So your internal rate of return would then be the return on investment 1.741 to the power of 1 over 7 minus 1, and this will give you 8.24. So the return here is going to be 8.24%, which is higher than what we got initially here when we take into account that there's an opportunity cost. Here, this investment mitigates this opportunity cost. It reduces the loss in sort of income because of not doing anything with the money that we have by investing it at 3%. Then we get a higher return of 8.24. All right. I hope that's clear. Now, there is also what is referred to as the public market equivalent. And this public market equivalent is looking at assets that are on the public market and using them as a comparison with private market investments. This is a bit difficult because the cash flows for private markets are not as regular as the cash flows in the public markets. But the private market fund investment internal rate of returns, they reflect an even timing of cash flows across private assets during the life cycle, right? So, which then creates benchmarking challenges, which is something I just referred to. The public market equivalent is used to compare the private market fund returns with public market fund returns. So this is an attempt to compare the returns on the public market and the returns on the private market. It translates uneven private market cash flows to comparable public market returns. That's what the public market equivalent does. It simply just translates the uneven private market cash flows into comparable public market returns. Okay, we are going to we use these comparables and then calculate an internal rate of return. All right, excuse me. So let's try and understand this. Basically, what we are going to do, we are going to look at a theoretical public market investment that we create. Then we look at the cash outflows, investments in the public market index, and then cash inflows, which is money sold from a public market index. And then we calculate a terminal value. So this is a hypothetical cash flow at the end of a private fund's life. You will see just now what I mean by this. But we just consider this terminal value as the end of life value for the private fund. we use this terminal value in the cash flows to calculate the public market equivalent internal rate of return. So this is calculated using the fund's cash flows, but we replace the exit value with the terminal value for the public market equivalent. All right. So let's look at this case study here. You will see that these are cash flows for Gladstone. This minus means money is going out. Here there's nothing, no money going and no money coming in the second year. And then money coming in, money coming in. These are public market index that we are going to use. They calculate the returns here. So these returns are just like returns here. 120 minus 100 over 100, 20%. 105 minus 120 over 120. Like if you want to see this 7.4, it's simply just 150 minus 140 over 140 times 100. That's 7.4. That's how they get these returns here. The internal rate of return for the fund is 10.5%. And the public market index compound annual return is 10.67. Let's look at the first question. Discuss why Gladstone should not benchmark its fund's internal rate of return against the public market index compound annual rate of return to assess the fund performance. So this is straightforward based on what we've been talking about. The irregularity of the cash flows, the irregularities of the cash flows in the private market, right? So the public market return is computed as an annual return, and it ignores the uneven cash flows that you would find within the private market. So as a result, it becomes a very difficult comparison between the private market and the public market benchmark by simply compounding annual returns. That is not a very good comparison because the returns for private markets are uneven. The public market returns they happen quite frequently, and hence they are compounded annually. So that comparison might not be an appropriate comparison. All right. The second question is you look at this table and you demonstrate how these amounts are derived. So show how these amounts are derived and consider any beginning of year cash flows to be received at the end of the previous period, right? So how do they get these cash flows? This 40 is the initial cash outflow, right? This is the money initial cash outflow, which is 40. And in the second year, from the initial investment, in the second year, there is a 20% increase, right? So there's going to be a 20% increase in the investment. What you simply do is you take this initial 40% to get here to year number one. You get the 40%. This 40% increases by this amount. You are comparing it to the public market return. So it increases by 20%. And then you add now this investment of 30. You add the investment of 30. If you calculate this, you must get 78. Once you have 78 now, and then you get onto the second year. The second year, I'm going to start with this 78. Okay? But this, according to the benchmark, you see the index went down from 120 to 105. So there's a decline of 12.5%. So basically 100 minus 12.5, it gives you 87.5%. So you multiply this 78 by 87.5%, 0.875, right? And then in the second year now, you're going to have 0 here. So there's plus, you add a 0, you must get 68.25. Then when you get to the third year, you take this 68.25 that we have now, 68.25. Then you multiply by what? Look at the return, 33%. It has gone up again. You multiply by 1.33, 33%, right? And then you're going to subtract 20. You're going to subtract 20 here. Subtract this 20. And then you get 71. Okay. In terms of the last value, what you just do, you assume that in this final year, there's going to be no cash inflow or cash outflow. And then you just take this value for the final year, you just take the value as it is, and you raise it by this percentage, which is 7.14%. So it's 7.14%, which means it's 1.04, it's 71. times 1.0714. And then if you multiply this, you're going to get this, and don't take into account any cash inflow or outflow. You consider this as the final value, and this becomes the terminal value. This is the terminal value. All right. This is terminal value for the public market equivalent. That's how you get these values. All right. So you've shown what they've asked you to show. Don't forget, that's how you get these values here. And then the third question now, evaluate whether Gladstone fund exceeds its benchmark. All right, we want to compare this to the benchmark. And to do this, we're going to take into account the cash flows that we calculated previously. And we are going to use our financial calculator, right? So you can use your financial calculator to calculate the internal rate of return, right? Based on the cash flows, you see that our initial cash flow was minus 40. The second cash flow, so remember, you take the cash flows for the fund, for the private market fund, and then the second cash flow was minus 30. The third one was 0. The fourth one was 20. The only thing that's going to change is going to be the last one, which is the terminal value. You use the terminal value that we calculated with the public market equivalent. So you take this value of 76.07, the final value. This is the from the public market equivalent, right? So once you do this, you're going to enter this into your financial calculator. I'm sure you guys know how to do this. You should know how to do this. But quite let me quickly show you here. I usually like to, you click on cash flows. I like to clear everything here. I clear everything, and then I put in the cash flows. 40, it's a negative, you enter. And then the first cash flow is minus 30, it's a negative, you enter. The third one, the cash flow 2, it's 0, you enter that. And 20, you enter. The frequencies are 1, 1. And then the last one is 76.07. This is a positive value, you enter. Then you go to the internal rate of return, IRR. Then you click on compute, and then you get a 9.86. Let's just say 9.86%. All right. So you're going to get an internal rate of return of 9.86%. Then you compare this to the fund. The fund, the benchmark with an internal rate of return of 10.55%, and this is greater than the private market equivalent, which is 9.86%. So you have answered this particular question. I hope you'll be able to do that. It's also a sort of like short practice as a reminder to how you use your calculator. All right. Let's wrap this up by looking at some of the other multiples that are used in the private markets. Okay. So we spoke about the internal rate of return. The GPs communicate performance to LPs using return multiples in addition to the internal rate of return. So your general partners are your GPs, which are the managers of the fund. Your LPs are the limited partners, which are the investors into the fund. Okay, and these offer detailed returns. These multiples, the major disadvantage of the multiples is that they ignore the value of money and holding period. They ignore the value of money in the holding period. However, the advantages of these multiples are that they differentiate between realized return and unrealized return. So there's a distinction between these realized return and unrealized returns. And they're also easy to calculate, and they are widely used by limited partners. which makes them so useful. So these are the two advantages of this, and we're going to look at each one of them in turn. Okay, so the paid-in capital is the proportion of total capital committed that has been deployed. That is the paid-in capital. It measures the progress in the investment over the life cycle of the investment, and it allows comparison across GPs, vintage years, and asset classes. The lower the paid-in capital expected in adverse market conditions, so a lower paid-in capital is expected when market conditions are not good. Okay, and GPs often raise new funds when the paid-in capital reaches 75%. Distributed to paid-in capital is simply the ratio of the cumulative distributions over the total capital invested. So this measures the realized return, the distributions to investors in relation to the total capital invested. And the residual value to paid in, this simply measures the unrealized return. You take the net asset value and you divide that by the total capital invested. The total value to paid in just simply adds. It adds the distributed to paid in plus the residual value to paid in. And that's how you get the total value to paid in. Okay. So in high growth industries, the total value to paid in is usually 3 times. And in mature industries, e.g. consumer goods, it's usually 2 times. All right. So just take note of that. And there's also the multiple of invested capital, which is also referred to as the multiple of money. This is similar to the total value to paid in, but it is considered gross of fees. Okay, we'll talk about fees when we talk about the different asset classes in private markets. But just take note of the fact that the multiple of invested capital or the multiple of money, it's similar to the total value to paid in, but considered gross of fees. All right. So this marks the end of the evaluation matrices for private markets. I want you to please do these questions, right? I know, like I said earlier, this is going to be a bit of a long session, but I want you to do this example, right? Pause this and then come back, just freshen up, try and understand what I was talking about, come back and try and do these questions. Okay, so pause it. If you paused and you came back, we'll come back. The first question is to calculate the funds paid in as of the end of year 2, this one. So the paid in capital as the end of year 2 is just the capital invested divided by total capital committed. So the capital invested as of year 2 is going to be this 1, 2, 3, these amounts here, 20, 40, and 30. Right? And the total capital invested is simply going to be 20, 40, 30, 10. 20, 40, 30, 10. If you add all of this, you're going to have 90 over 100, which is 90%. So basically, by the end of year 2, the company has called in 90 million of capital in 3 steps. 1, 2, 3 over the 3 years. So this is 90% of the 100 million of capital that was committed. Okay, so which means that this is near the end of its drawdown phase. It's near the end of its drawdown phase. 90% is quite high. Let's go to the second one, where you calculate the distributed to paid in. So the distributed to paid in is going to be your cumulative or your realized returns, cumulative distributions, and then these are divided by total capital invested. And this is equal to the cumulative distributions by year 7. You want to look at this by year 7 are going to be 10. These are distributed capital, 10, 25, 40, and 60. Then the total capital invested, we summed it up is 100 here. If you divide this, you're going to get 135%. So what this means is that after year number 7, the implication is that the limited partners, the LPs, they've realized cash distributions. They've realized, because remember, cumulative distributions, these are realized returns. They've realized 35% more than what they've invested. They've realized greater than what the total amount of cash that is investments. Okay, and then the total value to paid in. Remember, the total value to paid in. The total value to paid in is simply the distributed to paid in plus the residual value to paid in. The residual value to paid in is the unrealized returns, and these are the realized returns. Then when we sum this up, we are going to get this is going to be at the end of year 4. This is at the end of year 4. The residual values are also referred to as the net asset value. This one. These are the net asset value. And the distributed to paid in by end of year 4, it's only 10. So it's 10 and 147. So you add 10 and 147 divided by the total amount of money that was invested, you get 157. 157%. Okay. So most of the value of the fund is unrealized by the end of year 4. Most of the fund is this is the residual, the unrealized amount. It's unrealized. Only 10% has been distributed to the limited partners. All right. So I hope you managed to do this practice. Another set of very simple questions, and then we are done. Okay. So let's quickly do this. Which of the following statements is most correct? You can pause and then try them and then come back and do them. Which of the following statements is most correct? So here, option C is correct. Over a multiple year holding period, which of the following statements is most correct? Private market performance is best measured over multiple year holding period because periods of negative and positive cash flows. Remember, we have irregular cash flows. We have irregular cash flows in these private markets, and hence they have to be over multiple periods because of these irregular cash flows, right? And then number 2, discuss why vintage year is an important characteristic of a private market fund. So this makes it easier to make comparisons maybe between general partners. If they have the same vintage year, it means they have the same economic conditions that they've gone through. They face similar conditions. If they have the same strategies, then you can compare their performance over that particular time period within the same particular circumstances. So that's why the vintage year is important. Number 3, in private market investing, the J-curve effect applies too. So this applies to both individual investments and funds, where there's initially a negative net income and then eventually it rises, right, until it's the first negative and then eventually it's going to be positive, right? And then the last one, which of the following ratio is measured, is a measure of investors' unrealized return on the investment, right? The unrealized return is this residual value to paid in. The residual value to paid in is where you simply take the unrealized returns, which are also called the net asset value, then you divide by the total capital invested. All right, this is a sum of the distributed to paid in plus the residual value to paid in, and this is just the distributed to paid in. This is the realized return. So the answer would be option number B. All right, so well done, guys, for coming this far and sticking it out. I'll see you guys in the third and final section of this first part of private investments and structures. I'll see you guys soon. Practice, practice, practice. Cheers.